Hi everybody and welcome to this special live webinar event. I'm Terry Ryder, founder of Hotspotting. I'm here today with property investment expert Jason Paetow of AllianceCorp. And at Hotspotting, we have always regarded this year as the year of opportunity for property investors. We see it as a year that presents the potential to buy well in locations with growth credentials, achieve good rental yields to offset higher interest rates, and find rising income through rental increases amid historically low vacancies. Today, Jason Paetow of AllianceCorp will describe why switched-on investors right now are buying the dip, setting themselves up for future growth by investing amid a climate of reduced competition from other buyers, but growing competition amongst tenants for increasingly scarce rental properties. Jason Paetow, welcome.
Welcome, Terry. Yeah, thank you very much for having me. Always a pleasure. Look, we often have these chats, Terry, about sort of what sort of content we should have in these webinars. And look, honestly, over the last sort of 15 years since I've started AllianceCorp, I wish I had $1 for every time someone asked me whether it's a good time to buy. So I thought this would be a good topic. We both agree. So we've got quite a bit of information that we can sort of run through on some of these slides. But certainly for anyone out there watching today who's thinking about what their next move is in property, look, we always say that although there's some great opportunities at the moment, if you're looking to build a long-term portfolio and achieve some long-term financial goals, the best time to invest in property was always yesterday. So our rule has always been, as long as you've got the deposits, as long as the bank will lend you the money, get out there and start buying property. But certainly there's some strong signs at the moment as to why now is also an opportune time. So let's have a look at some of the data. Let's have a bit of a chat. And also to all the viewers, we'll have an opportunity at the end of this presentation to have a complimentary strategy session with one of the team to talk a little bit more about the opportunities that are being presented in the market today, and also possibly what locations, and also getting stuck into the various many location reports, Terry, that you and your team put together to provide some guidance on some of those hotspots. All right, so a little bit more just about AllianceCorp. So what we do in our business is we specialise in helping people build residential portfolios across Australia. We're not interested in just helping someone buy one property. We actually focus on building a portfolio of properties. So we're a little bit like a buyer's agent, but the difference with us is that we have lifetime membership programs with all of our clients. We educate the market on how to build portfolios, how the finance works. We do a lot of property wealth planning. We also have a research team. We have our internal research team and our external research team, and Terry's a part of that as well, to identify the best locations. We have an acquisitions team and a team of buyers agents that buy residential properties from across Australia. We also buy off the plan house and land packages, all different types of residential portfolios. And then we have ongoing mentoring and portfolio managers to manage those relationships and help clients get from one property to a second to a third. Investing in property will always be the most significant investments you'll ever make, whether it's an investment in your home or investment properties. And it absolutely makes sense to get professional advice. People don't question as to whether they talk to an accountant about their tax, or possibly a doctor if they're not well. And certainly estate planning or anything to do with financial planning, you'll reach out and speak to a financial planner. So our view is that if you want to set yourself up financially and get it right, that you definitely need some professional help and support. And also there's a lot of work that can go into researching properties, negotiating on properties, buying properties, and that's where our team can come into play. And we've been doing this for 15 years. So again, at the end of this session, if anyone wants a little bit more support or they want a more tailored approach, because everyone's situation is different, the type of properties, the price points, how many you can buy, what your strategy is very much tailored to your financial position and your financial goals. And that's something that we can cover off in our complimentary property and finance strategy session. So what does it mean to buy the dip? Look, I'm a property guy. I always have. I bought my first property at 20, but I also invested in other areas. Obviously, I've got my business and a few other businesses that I run. I do some developments, but I also trade in the stock market. I have been investing in shares in a long time. I also do some trading. Also got caught up in the crypto world as well. A lot of my friends got involved in that for a bit of fun. And often we always talk, whether it's property or whether it's shares or trading, we always talk about buying the dip, and our markets move in cycles. It doesn't matter whether it's the property market or the share market, it moves in cycles. And if you can always enter into the market when the market has gone through a pullback, or if it's the property market where it's gone through a correction, which is normal in our markets, it happens all the time. It's part of the normal mechanism within our markets. It needs to happen to get some of the heat out of the market, which we've experienced recently. Then the question is this a good time to get in? Do we get in now, or do you make the mistake like a lot of investors do, unfortunately, and they wait for everyone else to come into the market first? They need to see the market moving first to have that confidence, and it's that herd mentality. But often you'll find that when you do decide to get into the market, no longer now is it a buyer's market. It's now a seller's market. The sellers have all the power. There's some disadvantages with coming in too late. You've maybe missed out on a substantial amount of growth there. It's very hard to negotiate or get discounts. The vendors are getting what they want. So it's really important that, as I mentioned before, this presentation is not about trying to pick the market. Okay, I don't suggest you try to do that. Only sophisticated investors who study the markets, as a day job, might do that. Certainly, what I would suggest to you is that, as I mentioned before, you buy when you can next afford to. But right now, there's some really strong signs to get in there and start building your portfolio. Would you agree, Terry?
I do, absolutely. And you referred a moment ago to the herd mentality. Unfortunately, I think most people who seek to be property investors are herd animals. They follow the herd, which means they're piling into markets when they read in a newspaper there's a boom on, which means they've missed the dip, they've missed the best opportunities to buy well, and they're buying when already a substantial amount of growth has happened. So absolutely. I urge people to think and act counter-cyclically, to detach from the herd and make independent decisions with a long-term horizon.
Yep. So if you have a think about the markets and you have a think about some of the property cycles, another thing to remember too, when we think about our property market, this goes back to 1970, is that you will see these cycles, these ebbs and flows, and it's normal part of our property clock or the property cycle, and we'll have a look at that again shortly. But even there, you can see there, going right back to 1970, the old phrase "as safe as houses" is just so evident when you have a look at this graph here. You can have a look at all the different fluctuations in inflation there, the interest rates. You can see all the global and local, economic challenges, whether they're recessions or the GFC or whatever it is. And you can see there that consistently property is a proven long-term investment, okay? Because at the end of the day, it is a commodity that we all need. We all need shelter. We all need somewhere to live. There's always going to be demand for property, and there's always increasing demand due to population growth, etc. So we always say to the clients that, you are investing for the long term. You're not a property trader. You're not a speculator. You're not necessarily looking to try pick the dip and sell when it's high. That's for very sophisticated investors. But if you can get into the market when the market does turn and it starts to take off, what that does is it puts you in a bit of an advantage in that, your goal needs to be to build a portfolio of properties, not buy one property. And if you can actually get into a market where the market's about to surge, you're going to generate some equity pretty quickly in those properties, which is going to allow you to release that equity quicker and then put that money towards buying your second property. Now, obviously, there's things like servicing to consider and where interest rates are sitting at, but for the most part, you can't save yourself to wealth. And if you end up purchasing your first property, you're generally not relying on savings to get the deposits to buy the second. It just takes too long. On average, it can take 6 to 7, even 8 years for someone to save a deposit for a property. What you are relying on is being able to release some of that equity. Yes, sure, you can top it up with some savings, but release some of that equity from that investment property, or it could be that a home that you already own, and then use that money to purchase the second property. So again, if there's an opportune time, if the signs are right, to get into the market where there could be a little bit of a quick uplift, well, that's certainly going to help you get into that second property sooner. And why wouldn't you pay close attention to the signs, because the uplift can be quite significant. You know, when we think about property growth, it's not linear over time. We do go through the ebbs and flows, and sometimes if you look at a property cycle that might go for 10 years, the growth that you might achieve in the 10 years, you know, 70% of that growth sometimes might come from 2 or 3 years of a significant uptick in property values. It's not linear. You can see there on your graph, post-COVID, we had a situation where even going into COVID, the market was fundamentally strong. And then obviously the government slashed interest rates. We had all this pent-up demand during COVID. You know, people were saving a lot of their money. And then obviously when the market came good, everyone surged out there into the marketplace. The government threw out a lot of incentives. There was a lot of the builders grants and everything like this. And then when you've seen a massive uptick, so very quickly back in 2020 and 21, we saw some incredible growth and growth higher than what you're seeing on your screen. Some of our major capital cities had in excess of 30%. Now, off the back of that, we saw a correction, which is normal. We always see a correction, but just imagine you had got in just after COVID, and the average median price of property across Australia went up over 200,000. All right, and obviously for high price properties, it went up higher than that again. So it's really important not to ignore the signs, and remember too that even if you get into the market and you don't see the sort of growth that maybe you're expecting, as I said before, the rule is always you get into the market when you can next afford to anyway. Don't try to wait. No one's got a crystal ball, so it's not as if you're making a mistake to get in now with the view that, oh, maybe the market won't perform as much as it will, because the rule is always that. Get into the market when you can next afford to. But right now, we're seeing some pretty convincing signs that now is the time to get in. Now, a lot of those cycles have to do with our property clocks. So typically what happens is we're experiencing a bit of a downturn where now the market is sort of flattening out, and that typically comes off a market that's booming. So a lot of people, you know, sort of get a little bit concerned about the property cycles, and we try to explain that, look, again, you're not a trader. You're not getting in the market now and looking to sell in 12 months. You're going to be in there for the next 10 to 15 years or possibly longer. But over that time, you will go through some cycles. And typically your major capital cities used to go through a cycle every roughly 10 years. Some of your regional areas, it was a bit longer. But it has been harder to pick the property cycles most recently because we've had things like COVID to deal with and stuff like that, which no one would have ever foreseen. So it's sort of thrown out some of those cycles to a certain degree. But normally what happens is we see a bit of a downturn. We saw that last year, we lost about 5 or 6%. We lost a couple of percent again earlier this year. But again, coming off massive gains, it's not a substantial correction. And we need that to happen to slow down the markets. Now all of a sudden, though, we're starting to see a bit of a turn in those markets, which you'll see from the next slide. So the biggest impact, obviously, was interest rates coming off the back of COVID. We had record low interest rates, inflation, and shortages in supply due to our global networks off the back of COVID. Unfortunately, forced inflation up quite quickly globally, and really the only measure that we have to deal with that is raising interest rates quite quickly as we did. But look, even at interest rates of a cash rate of 3.85%, average interest rates prior to COVID were around 3% anyway. So yes, they're a little bit higher than average, but I guess the shock to most people is that they seem a lot higher because we came off record lows. But in effect, they're not that high if you have a look at historical data. When we have a look at what we were able to achieve for our clients, even though we had a bit of a correction last year, our clients didn't really notice that impact. So in our team, we actually look at all the markets nationally, and there's markets within markets. So even though you might have a national average saying that the market's dropped 6%, you'll have pockets throughout Australia that have actually increased. That's still 5, 10, 15%, right? Because it's just a national average. If you think about the property market, think about dropping pebbles in a pond. Different areas will take off at different times. And just because the national average is low, it doesn't mean to say people haven't made money in property. And it's evident there on your screen. Our clients, the average return for our clients where we invested in WA during the same period was approximately 12% return. In Queensland, we still had 32%, even though the major capital cities were coming down. Because generally in a property cycle, it starts with the major capital cities and then it filters out into the outer regions and into the regional areas. But the reason why we're so successful in a lot of our returns is that we also target very affordable locations. So our average purchase price for our investors is as low as 350 to 400,000 for an entry level property to get into some of these regional areas, and it might be an established property, right up to about sort of 657, 750, but we don't go much higher than that. Now, when you're targeting those sorts of price points around the country, and you're able to follow the markets and chase the markets, there's always going to be people who can afford to buy those properties. Therefore, the demand is always pretty consistent, and certainly people that are hanging onto those properties can afford typically the repayments or any fluctuation in interest rates. So we tend to find some in that affordable price points, the properties are more consistent and less volatile in terms of any price movements that take place in the market. Would you agree, Terry?
Absolutely. There's a enduring myth in real estate that you get the best capital growth by buying in the so-called prime areas, but I think the research actually disproves that. The point that you just made is that the affordable properties always have the demand from the masses because the greater majority of people can afford those areas. And the research shows over recent years, or over a longer term time frame, over 10 years, that it's indeed the more affordable areas that in percentage terms have some of the best long-term capital growth rates.
Yeah, absolutely. And look, I remember 15 years ago when I started my business, I used to just buy established properties, and I used to buy them in the inner suburbs. I wouldn't go more than 12 kilometres out from the CBD. But back then you could still buy 1 and 2 bedroom flats or villa units or some places in freestanding weatherboards in Footscray for as little as $400,000 to $500,000. Now it's well over $1 million, and a lot of people just can't afford to invest in that sort of property. But also the rental yields tend to drop off a little bit, making it hard for servicing and being able to continue to grow the portfolio. So certainly you need to be looking nationwide, and you need to be also targeting some of those regional areas. So where are we at the moment? So 2023. So the markets are now sort of normalizing. Interest rates are slowing down. We might be looking at one more interest rate rise, maybe not. We're not sure at this stage, but certainly no one's forecasting much more than maybe possibly one. The stock on the market has tightened. Rental incomes continue to rise, and that's still going to be a problem, particularly with migration. Capital growth forecasts have been between 3 to 7%. You can see there from SQM Research, who again we generate a lot of our data from, are predicting somewhere between that 3 to 7%. And again, we will continue to outperform the market, and we'll have our results as we get closer towards the end of the year. In terms of 2024, look, we're starting to see a bit of a surge in the market. Wages continue to rise. We've got 7 rate cuts already predicted by some of the banks. Westpac have already come out and said that next year we're going to be looking at some of those cuts, which we'll talk about in a moment. We've got record migration. We've got housing shortage pressures still, and sentiment is rebounding. So as I said before, to all the viewers, don't wait until you get into next year or halfway through next year or whatever before you start investing, because a lot of the investors are already starting to flood back. We've also got continued pressure on rents. We've got on migration topping out at 400,000 now. Again, a lot of people don't agree with the government's move there, but the government's position is, well, all we're doing is playing catch up because the migration levels were so low in the previous years, and we're just getting back to where we would have been anyway. But again, it's putting a huge amount of pressure on those rental properties and available rental properties. And what we tend to find when people migrate into the country, they tend to rent for the first or second year before they sort of settle, and then they start purchasing. So again, putting pressure on housing, and we already have some housing shortages there. You can see there some of the rate cuts that have already been forecasted coming into next year. So normally what we see with interest rates is, historically, when they have peaked, they haven't peaked for long. I used to get a lot of clients say to me, Terry, oh, but I remember the days when interest rates were 16% and all this sort of stuff. And I get that, but it was literally 16% for 3 months. And then it came down sharply. So we do tend to see that interest rates will go up from time to time, particularly in this instance for inflation. But once we're on top of inflation and we can see that inflation is coming down, very quickly they start to come down again. And again, if you look at average interest rates in terms of the cash rate, you're looking at an average about just under 3%. In terms of variable rates, in around 5%. So that will start to come down quickly. And as I said to all my investor clients, like, you're buying for the long term. All right. So over the long term, in terms of a little bump in interest rates, it's not going to be neither here nor there in terms of the performance of your property. And also we structure the portfolio to have separate accounts to manage fluctuations in interest rates, so you're not having to find the money. And we do that through what we call our master facility programs, which again can be covered off in our complementary strategy sessions. Some of the biggest benefits to buying the dip is, as we talked before, to reduce competition. So you can actually get out there and negotiate. We're negotiating a lot of established properties and getting some great prices there. Also, typically dealing with the developers. It's hard sometimes to negotiate with the developers because a lot of the developers worked on fixed pricing, but still you can negotiate other things like additional inclusions in the properties and other sort of incentives for the investors. There's a lot more room for negotiation. There's obviously a lot more greater choice if you've got less competition out there. More attainable price points. So there's still some great pockets in around Australia that are still very affordable. But even now, some of those pockets only need, you know, a little bit more growth, and then again they're going to become unaffordable for a lot of investors, particularly those investors that are struggling to get into the market. And a big part of that again is interest rates. And look, some people might argue, okay, well, we'll just wait for interest rates to come down. But again, you run the risk that if you do that, that property that you could have bought today might be worth another $20,000, $30,000 or $40,000, you know, in 12 months' time. So, yeah, we're definitely in a buyer's market at the moment, but that can change very quickly. In terms of the housing shortage, again, we've consistently having to deal with this issue of housing shortage. It is on the agenda for the government. They don't seem to do much about it, but again, we've got some shortages there, particularly as our population increases, and some challenges there facing developers and builders and restrictions and permitting and all the rest of it. So that's only going to get worse as we continue with these high migration levels coming into the country. As I said before, as they look to start to settle and purchase themselves, again, that's going to put continued pressure on housing, and again continue to drive up prices. One of the charts that we look at regularly is the consumer price index. All right, the consumer price confidence index. And the reason for that, regardless of what's happening in the marketplace, at the end of the day, it's the buyers and sellers that dictate what the market is doing based on their behavior. And so if we're able to track that behavior and then relate it back to what's happening in property prices, it's actually very predictable. You can see there that blue line is consumer confidence in the marketplace. Okay, and then the red line is the performance of or movements in the property market. And we generally find there's about a six-month delay in what's happening in the index versus what's happening in the property market. And you can see there that just recently we had COVID back in 2019, 2020, where consumer confidence dropped to all-time lows. And you can see that now with inflation and higher interest rates and the cost of the cost of living increasing, that again we've dipped quite significantly. But already now there are some signs that the market is turning. Okay, so you can see that happening there on the graph, and it's something that can't be ignored if you want to get in at the bottom. There's also done a lot of research done by API through the API Property Sentiment Report. There's signs emerging there that consumers can see that we're turning the corner. There's a lot more respondents now are felt more positive about the current state of the property market. So we can see an increase there, and that's obviously evident in the fact that we've had positive growth over the last few months in our property market as well. You can see that also too in the consumer confidence trends there. While affordability is still an issue for a lot of people, as I said to investors watching, if you're frustrated, if you're wanting to buy a property, you might be located in some major capital cities and just go, I don't understand how people are building these portfolios. Well, as Terry and I have mentioned a lot, you don't have to restrict yourself to the major capital cities. You can go into these regional areas. There's some fantastic regional areas that have done incredibly well, and you can get in at a very low price point. As I mentioned before, we go in as low as high threes to about 400 is sort of the lowest that we can go. But again, in terms of this report, over the next 12 months, again, a lot of people have have increased confidence. It's gone from 16% already to 29% in terms of people being, again, a lot more confident about what's happening in the property market. And again, this is evident in this graph too, in terms of the consumer confidence trends. 6 months ago, 2/3 indicated that interest rates had no bearing on their real estate investment. 3 months later, that figure was down to less than half. Currently, it's just above 1/3 of respondents. So savvy investors understand that while interest rates do impact your ability to borrow, as a long-term strategy, they shouldn't impact your decision to buy, because again, you're buying for the long term. All right. So we tend to find that if we are foreseeing that interest rates are going to be potentially higher in the future or stay higher in the future, we can target properties with higher yields. And if we target properties with higher yields, that would go a long way in offsetting interest rates. But also too, investors need to understand that property investment is not just about trying to pick the best location, all right? Or the best sort of property. It's about understanding how your finance works and putting a finance strategy in place. All right. At the end of the day, the properties are just neatly packed pile of bricks, right? You're just using it as an investment vehicle. In order to get the money to buy those properties, you've got to work with the banks. You've got to understand how the finance works. And in terms of you being comfortable with debt and being comfortable with fluctuating interest rates, you need to have a master facility there that manages all the cash flows. So you don't actually put money into your investment portfolio. You'll have your own personal funds that you receive. If you've got a mortgage or whatever, you use that to pay off personal debt. But you'll have a separate facility, a master facility linked to all your investment properties, or your rental income will go in, or your costs will come out. And if there's fluctuations in interest rate, it won't have a significant impact to your cash flows because you'll have buffers in place. You'll be able to release equity and things like that. So having a good understanding around the finance also goes a long way to remove a lot of those concerns that people have when they think about fluctuating interest rates and things of that nature. As discussed, it was a bit of a surprise. Terry, did you pick it? I don't know if you picked it, that we already were going to see some positive growth in the last few months.
Actually, we did. It's what we forecast for the year. Late last year, when we were making our predictions for 2023, our basic stance was that 2023 was going to be a solid year of growth, and probably not a boom year, but a year where most locations would produce moderate to good growth. And we saw it as a year of opportunity. We thought that the economists that were predicting 15, 20% drop in property values were going to be proven wrong yet again, because they over-rely on the impact of interest rates. We think there are other forces in the market that are as important or more important than what's happening with interest rates. And the big factor that we saw was that probably the single most important word for investors right now is shortages of everything. Shortages of rental properties in the market, shortages of listings of properties for sale, and also shortage of new dwellings. We're not building enough new dwellings. All of that adds up to a very powerful equation, which equals opportunity for property investors. So we're not surprised to seeing those latest figures coming through from CoreLogic, from PropTrack, from SDM Research, showing that we are actually seeing property values increasing in the early part of 2023 in most cities and in regional markets.
Yeah, absolutely. Yeah, well, look, I knew that obviously the market was going to be turning this year. I was a little bit surprised that it happened so quickly. But yeah, it's definitely giving us some signs that we're obviously moving in the right direction. This is also another indicator that we refer to regularly, and that's increase in lending. Okay, so you can see there from the lines on the screen, you've got your owner occupiers, and then you also got your investors there, the purple line there on the bottom. And again, we can sort of see that change there in lending taking place, as again, we see people getting more comfortable with where the property market is at, and we see a bit of an uptick there in demand. And there's more and more people now starting to look at going back to the banks, going back to the lenders, and engaging in some lending activities there to purchase their home or purchase their investment property. In terms of where we sort of talk, and you and I can sort of talk a little bit, and this is your expertise too, Terry. we purchase all over Australia. So wherever we see that the markets are looking strong, we'll go in and we'll target those locations. And we do sort of target affordability as a big focus. Our general view is that I would prefer a client maybe have 2, 3 or 4 properties in their portfolio at a more affordable price point, as opposed to just one investment property, putting all your eggs in the one basket. The challenge with buying something at a much more higher price point too is generally the rental yields are a little bit lower. If you're looking to purchase something over $1 million in some of these major capital cities, you might find that the holding costs could be as high as 200 or 300 or even more if interest rates are high. And that's just not manageable for most people to go to bed at night knowing that their investment property is costing them, hundreds of dollars each week. So we always tend to try to target properties that are more sort of neutrally geared. And, when they're neutrally geared, when interest rates are a little bit higher, yeah, sure, the properties might generate some negative cash flows, but it might only be $50 a week or something like that. But again, if it has any negative cash flows, those negative cash flows will come from a separate facility that has surplus funds. And those surplus funds are topped up from the equity from the investment properties, so it doesn't impact the investor. But then certainly when interest rates come down, those properties can become also cash flow positive. And as rents continue to rise, and if interest rates fall a little bit, that surplus cash flow can then feed into paying off the mortgage or paying off some personal debt, or can simply feed back into the master facility to help create deposits to buy the second, the third, the fourth, the fifth. But it's very important to have a national view. Often still we do talk to clients that are going, we say whether you want to buy, and they go, I just want to buy in the local area. And we go, well, okay, well, you already got a home in that area. You're already exposed to that location. It could be that your home's worth $1 million or more. Wouldn't it make sense maybe to target a different location and again, not have all your eggs in one basket and just diversify? And again, because the markets nationally take off at different times, they have been quite correlated over the last few years. But generally, if you have a look at some of the data going back a few years, you'll find that, there'll be periods there where Sydney takes off or next year Sydney slows down and then maybe Melbourne takes off or Perth, and they don't always correlate, all the cities, and certainly all the regional areas don't correlate. So if they're not all correlating, well, wouldn't it make sense just to target those areas that are showing signs of some positive growth, as opposed to just buying all your properties in the one location or the one city? So that's why it's really important to work with, obviously, groups like Terry and Hotspotting to get access to all that latest property information and data. And obviously very important to work with groups like us to first understand what is your finance strategy, what sort of goals are you trying to achieve, and then start to look at what the locations are doing nationally. So Terry, do you want to give us a bit? This is a location that we're having that we're looking at closely as well with a lot of investors. We did a lot of investing, particularly in WA over the last few years as well. And the main reasons for that was price point, particularly through 2020, 2021. A lot of the other areas that, again, we would invest in heavily, particularly up the east coast of Australia had significant growth during that last boom. So that made looking at WA more appealing. And also, WA also had very high rental yields. They had lower price points and very strong rental yields. What's your thought on this particular location?
Well, I mean, just referring to your comment that we don't have just one market in Australia, we have different local markets and quite often doing different things. Certainly a big contrast between what's happening at the moment and recently in Perth and some other parts of Australia. We've just been working through our quarterly analysis of sales activity right across Australia, and whereas there are some parts of Australia where sales activity is down quite markedly, it's certainly not happening in Perth. Sales activity is still rising in Perth. Perth is still very much a very strong and competitive market. One of the strongest part of that market is the city of Wanneroo up in the north. It's one of the strongest population growth areas, not just in Western Australia, but anywhere in the whole nation of Australia. It's an area of new growth. It's an area with increasingly good infrastructure. It's an area that offers affordability. That's one of the reasons why it's getting so much demand, particularly from young buyers. And we're still seeing sales activity rising in the suburbs of the city of Wanneroo. And when that happens, prices rise as well. So there's certainly no signs at all of waning of the strength of the Perth market, and it's very much being led by the more affordable areas, and that includes Wanneroo.
Absolutely. So again, if for anyone that's watching, in terms of a price point, typically you're coming in around that sort of 450 to 575, but we can also get a little bit lower than that with some of the older established properties. And with that sort of entry point into the market, that's affordable to most investors, and still the rental yields are quite strong. And so again, so if you're interested in looking at WA, this is a great location. It's just north of the CBD. There's plenty of new infrastructure. You've got the Metronet rail extension going through there as well. And it's very close to the city hubs there in terms of Alkimos City. And very, as I mentioned before, very affordable. So, and look, with the clients have done incredibly well in this location over the last few years. What about Adelaide? So Adelaide again is caught our attention, particularly over the last couple of years. Adelaide's, city of churches. It doesn't always sound that exciting, and it's always been one that tends to stay under people's radar. But again, the returns have just been consistent. If you look at the historical concerns, returns, they're very consistent. It just sort of prods along and does its thing, but it just doesn't have the I guess the same sort of interest as some of the East Coast cities and also WA, and it goes under the radar a bit. But in terms of a long-term investment, it's been a true performer. And certainly the city of Playford is something that we pay close attention to, Terry.
Look, I think it's time for people to cast off that old attitude that Adelaide is an unexciting city, that it's a low-growth city. That information is 10 years out of date. Adelaide has been one of the best performers anywhere in Australia in the last 10 years, and it continues to be a strong market. As I mentioned, we're doing our quarterly analysis of sales activity, and it showed that Perth is still pumping very strongly, but also shows that Adelaide is being very, very consistent. We haven't seen any signs of fall off of buyer demand in Adelaide. And one of the things that is keeping the Adelaide market very strong is the fact that the underlying economy is so strong. People probably have the attitude that, South Australia, not one of the growth leaders in terms of economic activity in Australia, but in actual fact it is. The latest edition of the CommSec State of the States report, which is something we always track, it comes out quarterly, and it has quite a correlation between the findings in that report and what's happening with property markets. And in the latest edition, the economy of South Australia ranks number 2 in the nation as the second strongest economy in the nation. And that's one of the reasons why the Adelaide property market has been so strong in recent years. And the city of Playford, it's all about affordability. We've mentioned that word a number of times in this presentation today, but it's very much what's driving people's choices in markets. And the city of Playford is the most affordable part of Adelaide, which is one of the most affordable capital cities in Australia. So we're still seeing really strong demand, and we're still seeing very strong price growth happening in the suburbs of Playford and neighbouring areas like Salisbury. So still very much a strong market, and I expect it to continue to be. There's so, that old myth about everyone works in the CBD. Well, it's never been the case, and as time goes on, that's less and less true. In Adelaide, some of the biggest jobs nodes where most people work up in the northern suburbs, the big Edinburgh Defence Facility, the big commercial industrial precincts up in the north of Adelaide. That's where most of these people work, and people like what drives people to choose location is where can we buy affordably close to where we work. And for people in Adelaide, for many people in Adelaide, that means places like the city of Playford.
Absolutely. And then, of course, there's the city of Logan. So we've been investing in Logan for many, many years now, and it's seen a massive uptick, particularly during the last boom as well. We were purchasing properties there, and we were purchasing some new properties and house and land packages as little as 400 to 450 a few years ago, but that has jumped up considerably. But still, in terms of price point, if it's something new, we're sort of looking at the mid-5s to sort of mid-6s or close to the 7, which is still affordable for a lot of investors. And there's a huge amount of activity there, and you've got a projected growth population growth there of 500,000 people by 2036. So, and obviously Brisbane's got a great story with the Commonwealth Games coming up and things like that as well. But what are your thoughts on Logan?
Look, we've just talked about Wanneroo, the affordable north of Perth, and Playford, the affordable north of Adelaide. Well, Logan's kind of the comparable place in Brisbane, except it's in the south. And it's a great location to be in the south because it's the urban bridge that links central Brisbane to the Gold Coast. So it's very much a growth corridor. If people can't afford the ritzy suburbs of the Gold Coast or the inner city suburbs of Brisbane, Logan's a great option because it offers that affordability at halfway between two desirable places. Great infrastructure, wonderful retail offering, great transport links, the Pacific Motorway, as well as the rail links that link Brisbane to the Gold Coast, and lots of new infrastructure coming up. And that's a big driver of growth in property when you've got multi-billion-dollar projects happening in an area. That's creating jobs and economic activity, and that drives property prices. So Logan's got all of that in the mix. And as Brisbane goes forward with its big infrastructure spend heading towards the 2032 Olympics, Logan's going to be carried along with that momentum.
Absolutely. And then, of course, there's the one that we love, Terry, regional areas. So again, always been a massive advocate for some of these regional locations, particularly with clients that are looking for high yields. So again, depending on what phase you are in your investment journey, we would have sometimes a lot of clients who are close to retirement and already have their home with quite a bit of equity in it, or they might have one or two investment properties there in a major capital city. But now that they're transitioning through retirement, they want high yielding properties. So we might target some of those high yielding properties for those clients, or again, entry level clients coming into the market that don't have the price point that the big cities have. Again, regional is good. And look, you and I had these chats. I saw a lot of sort of media reports over the last sort of year or so that maybe regional had run its course and that people were starting to pull away, but none of the population data, there's no evidence in any of the population data that that's actually happening. And we've been seeing a shift into regional areas for the last 10 years. That's
right. We referred a couple of times today, Jason, to a couple of major myths that prevail in property. And one of the biggest ones of all, because of media getting it wrong, is that the shift to the regions was caused by COVID. Well, in actual fact, it's, as you've just referred to, the population drift from the biggest cities to the regional areas has been happening for about 10 years in large numbers. And it's not about COVID, because it predated COVID. It's about technology. It's about the ability of people to work remotely. More and more people are making that realization that they don't actually have to be in Sydney or some of the other big cities to do what they do for a living. They can be anywhere doing what they do for a living. So people have made the choice to move to lifestyle areas, to more affordable areas, to smaller cities, or to regional areas. And all the population data suggests that that's still happening. The latest figures from the Bureau of Statistics show that the population growth rate for the regions of Australia now matches the population growth rate for the capital cities, because traditionally it's been the capital cities have dominated, but now it's even Stevens because more and more people are moving to the regions still. So very much a trend. And that's the reason why we've seen so many regional areas around Australia outperform their capital cities in, say, the last 5 or 6 years in particular. Yeah. So again, some great draw cards there. That lower price point, again, with typically a lot higher yields as well. So a lot of people have seen this statement by Warren Buffett: be fearful when markets get greedy, be greedy when markets get fearful. So again, if you can buck the trend there and get in early, while a lot of people are sitting on the fence, well, then you'll reap a lot of those rewards. So even over during COVID in the last couple of years, we had the same experience with a lot of people that were coming to our business, or a lot of existing clients, where we would do your regular portfolio reviews, and a lot of clients are sitting on the fence going, oh, well, there's so much happening out there, and then there's COVID, and now we've got inflation, now we've got higher interest rates. And the clients that stuck to the rules, which are, as long as you can borrow the money, the banks will lend you the money. As long as you got your deposits, as long as you got a little bit of money left over in your master facility or buffer, you just keep buying, you will do well, all right? Because we don't have a crystal ball, and it's a long-term strategy, all right? We will gauge the performance of your portfolio, not in the next 12 months, but in the next over the next 10 years. So this is one of our couple, Michael and Michaela. They were a couple of young working professionals, want to set themselves up for the future.
They wanted to put in a retirement plan, generate some passive income, etc. So by joining the business, we were able to help them, and this is just over the last 3 years, build a portfolio of properties. And as I said before, this is the focus. So they had a home there with some equity. We released some of that equity into what we call a master facility. We used the master facility to cover the deposits on their purchases. You can see there the first one was in Logan. So we got a couple there in Queensland, then we got a couple there in Geelong, one in Geelong and one in Craigieburn here in Victoria, and then we had one in WA. So again, chasing those markets nationally. And they were able to do this without any impact to their lifestyle, because that portfolio is set up independently of their personal cash flows. That portfolio funds its own expenses, its own loan repayments, and it's all done through the master facility. And there is money left over in the master facility to cover any sort of incidental costs that pop up or fluctuating interest rates, etc. And then over time, we release the equity from those properties and push it back into that master facility account that you can see there next to their home. So what have they been able to generate over the last couple of years? Well, $765,000 worth of equity uplift. So they're absolutely ecstatic. And they did this because they didn't sit on the fence when everyone else was sitting on the fence, whether it was because of COVID or interest rate rises or, oh, let's just wait and see what happens next year or the year after. They just got out there and they followed the rule, and our acquisitions team and property wealth planners were able to build in this portfolio and generate an incredible result. So they're super, super excited. So as I said at the start of this session, Terry, if you want to learn more, then absolutely you can access one of our complimentary strategy sessions, normally valued at $500. What we do in these sessions is we have a look down. First of all, we have a look at the numbers. We have a look at your current financial position, your ability to borrow. Then we have a look at what your financial goals are, whether it's short-term, long-term. We talk to clients about the RentVest strategy, about potentially investing first in properties before you buy the home. We talk to those viewers who have equity in their home, how to release it securely and safely, and then be able to use it for investment purposes, like the example that I just showed you. And then off the back of that session, the viewers can, it's a complimentary session, they can make the choice to come back for some more sessions to have a look at how we build the portfolios, what are the areas, what are the strategies, how do we get really good prices on these properties, how do we structure a portfolio to fast track their results. And then at the end of that experience, if they want to become a lifetime member, they can, just like Michaela. And if not, you can take all that information, you can take all that strategy, and the viewer can then try to use that information and build their own portfolios. But as I mentioned earlier, if you want a professional outcome, work with professionals. So in our business, we've been doing this for 15 years now. We've got close to 50 staff who run around that are made up of property wealth planners, finance strategists, acquisitions teams, researchers, post-purchase teams, portfolio managers, all designed there to work with our clients long-term, not just helping you buy one property, but help you build a portfolio property, and then work with you in the future then to exit that strategy. So that involves maybe selling off a few of those properties, paying off the ones you have left over, or also doing some investing through your self-managed super fund, and working with financial planners and accountants at the end of that the property wealth strategy to generate passive income and achieve all your financial goals. So that's what's available to the viewers, Terry. So all anyone needs to do is just click on the link. The sessions go for approximately 90 minutes. We can do it online, so we can just do it online for you. You can do it from the convenience of your home, and we send you a whole heap of free education, ebooks, videos, things like that also, to give you all the confidence you need to get out there early, all right? Not wait to hear it in the papers, 6 months down the track, 12 months, the market's now, booming again, taking off, and you're like, well, crap, what did it cost us by not getting in 12 months ago, or not working with a group that could give us the confidence to get into the market earlier, because we just didn't have the confidence to make that move ourselves. And then as we've discussed, a group that can target all the different locations across Australia, all the major capital cities, all the regional areas, and looking at both established and new or off the plan, because there are a lot of groups out there that will just go, oh, established is the only way to go. All right. And then there'll be other groups that say, no, new or off the plan is the only way to go. we understand as investors ourselves that both strategies can complement each other, and you can have both types of properties in your portfolio, which is super, super important.
Jason, I've lost track of the number of conversations I've had with investors who are planning to buy around the middle of 2020.
Yeah,
they're ready to go. They had everything they needed, but they started reading in newspapers that prices were going to fall, so they decided not to buy, and they seriously regretted it, because by the time they realised that the economists had got it wrong with their predictions, but by the time they realised media was wrong with their forecast of prices falling, they'd missed out on 20% capital growth on the property that they would have bought. So I urge people, if they want to become property investors, they're ready to move. Don't let negative media stop you. Take advantage of the opportunities that exist in the markets now. Many of those markets are in that dip phase that Jason's been talking about today. But I think the key message I'd like to give people is that it's so important to build your team before you build your portfolio. You've got to gather around yourself a team of experts and advisors in the areas of finance, building strategies, all the people who are specialists in their field. Build your team, talk to people like Jason and his team, and then start to build your portfolio from that. But you've got to invest in advice, and you've got to invest in information before you invest in real estate.
Absolutely. And look, and the viewers got nothing to lose, because as I said, these sessions are complementary. So we're a performance-based organisation. The way in which we work is that, there's no obligation on any of our clients until they've experienced all the programs, reviewed all the strategies, reviewed all the properties, the locations, everything that we've put together before they make a decision. So you've got absolutely nothing to lose by getting out there and getting some good quality professional advice.
Yeah. So I urge people, we've still got a little bit of time left before we finish the broadcast on the half hour. So please, let's have your questions, type them into the chat box or the Q&A panel. David is not so much a question, but made the comment that I think referring to something you said earlier in your presentation, Jason, that once interest rates drops, consumer confidence will improve, and then everyone will pile into the property market. So the smart investors need to get in now. And I think that's very much on message, the message that you've been imparting today, and which I heartily agree with. Don't wait till you read that there's a boom on again. If you're ready to go, move now. Take advantage of the fact that it's less competitive, because once consumer confidence returns, everybody's going to be piling into the market, and that's when it starts to get difficult.
Yep, absolutely.
Okay, so just type your questions into either the chat box or the Q&A panel, and don't waste this opportunity to ask key questions about market issues or about locations or about strategies that may be of interest to you.
And I think too, what's important to know, look, I think consumer confidence is going to bounce back very quickly without even waiting for the interest rate rise. Just the fact that people know and can see that we've had the last interest rate, and there's not a lot of evidence there or reporting that we're going to receive any higher interest rates. Because the challenge is, and you mentioned it before, people can't make their decisions based on media reports, because it's all clickbait. Everyone's fighting for the clicks, and you're only going to read stuff that's been sensationalized. It's either the market is going to crash or the market is going to boom. You very rarely see anyone write an article saying, hey, you know what, guys, the market's just doing what it's always doing. It's just prodding along, doing its thing. That's just boring. Nobody's interested in that. So unfortunately, people, aren't getting the best information, and definitely need to speak to the experts.
A lot of what's in media, Jason, is consists of the forecast from bank economists. And right now, all the bank economists are updating, that they like to call it updating their forecast. They're actually changing their forecast. They're contradicting what they're forecasting only months ago, because they started the year predicting that prices would fall, and they've been contradicted by the actual outcomes in the market, because they overrated, I think, the impact of rising interest rates. Those increases in prices that we've seen in many markets around Australia in February, March and April, as charted by CoreLogic and others, happened despite the interest rate rises. So they overrated that factor, and so we're now seeing prices rising again, despite all of that. And as more and more people get that message, I think we're going to see people coming back into the market in greater numbers. People are starting to put their comments and questions into the Q&A panel. There's a question there asking about any hotspots in the Sydney market set to rise. Is that a market? I know that you tend
it's been tough. Like, so obviously we've been very active in the past, but again, our strategy is very much targeted towards affordable properties. It's very hard now in Sydney to find pockets that are affordable, and certainly when we're looking at property, it's just not price point. It's the reality is of a rising market, or a market that's done incredibly well, which we know is Sydney, is that the growth outstrips rental yields. So rental yields will continue to prod along, but if you get significant growth, your rental yields become so low. So we always say to a client that when you're thinking about buying a property, you've got to think about the impact that that property will have on your borrowing capacity to get the one after. And if you target something that has very low rental yields, it's going to stuff you up with the banks when they do their assessment to say, well, your borrowing capacity is dropped now because you've got such low yields. We're going to struggle to give you finance for the second one. It makes it hard for people to move into the second, the third, and the fourth property. So unfortunately, unless we've got some really high net worth income clients that can afford to buy at a much higher price, can afford to take a hit on lower rental yields, for the most part, most people are more comfortable with properties that have neutral cash flows. They can see that there's going to be some capital growth, and they can see that they can grow their portfolio beyond just owning one or two properties, which is a problem because 95% of investors only own one or two, and one or two is still not enough to achieve significant financial goals. Generally, we recommend about 3 or 4, and one of those might be in a self-managed super fund.
One of the things you've always emphasised in your presentations, Jason, is the importance of getting that first one right so that it does generate equity so that you can get the next one. The more you can do that, the easier it is to keep going back to the bank and asking for money to do the second and third and fourth purchase.
Yes.
Gary is asking about whether you feel there's anywhere worth focusing on in regional Queensland.
Yeah, we're doing a bit in Townsville at the moment as well. We still do up the North Coast as well in Queensland as well, but those prices have jumped significantly as well. But we are doing a lot in Townsville. Townsville is really taking off, and we've still got very affordable price points in that particular region as well. Yeah,
certainly. We think Townsville is a fantastic regional city with a very broad and strong economy. We've just updated our report, in fact, for Townsville, and I'm always amazed at how much is happening there. The multi-billion-dollar projects that are happening in Townsville, and that drives property prices in a city which is incredibly affordable and really good, strong rental yield. So it's certainly one to consider. There's other markets in regional Queensland, including Rockhampton, Gladstone, Toowoomba is one that we like a lot as well. Yeah. There's a question here: if you're going to buy in the next 3 months and had 400 to 800,000, it's a very broad question, hard to answer in one sentence. What 5 places would you think would be worth considering to do a renovation, to invest, to gain a good yield and long-term growth? That'll be a 1-hour strategy session, I think, Jason.
Yeah, and it depends on the client situation too, because when we do our property wealth planning, it's always not about where does that first property sit or what is that price point. It's always about, well, okay, if we purchase that property, what options does it create for the second, the third, and the fourth? It's always about property wealth planning. So it's hard to sort of pick it. And it depends on sort of what yields we need once we've got a finished product. Are we looking to sell the property on sale, or are we hanging on to it? If we are hanging on to it, what do those yields look like to support financing? So always when we talk about the client's first purchase or next purchase, it's always with the view on how it impacts the second one. So look at any of those regions that we sort of talked about today, meet that price point, and you can certainly find some fixer-uppers in any of those regions. So even what we discussed today can be achieved if you want to sort of add value to a property, which is something that we did. I'm a licensed builder. We had a renovation business when I started AllianceCorp, and we still provide some advice around that. But yeah, we'd have to look at the whole strategy in terms of what we're trying to achieve with this portfolio.
David's making the point, and I think it's a point worth making, that some of the lenders are starting to change their assessment criteria because they realise that with rising interest rates, some people are being sort of kept out of the market because they don't meet the old criteria, and they're starting to relax some of their assessment rate buffers, and also how much of percentage of rent they will consider in servicing the loan. So those things are starting to emerge, which are favourable to people wanting to get into the investment market.
Absolutely. And as I said, all the clients, you need to work with a specialist, all right? So you can't just work with your bank because you're very limited. You need to work with a mortgage broker who specialises in helping investors, which is very different from also mortgage brokers that only help home buyers, or what we refer to as vanilla home loan writers. And understand too that even your broker that you're talking to, while brokers will say they can access all the lenders, the reality is they only access half a dozen, because it's impossible for any broker to understand the policy of more than, say, 6 or 7 lenders. So what we have is we have an external team of brokers nationwide, and these guys are specialised in helping investors secure investor finance. But if we find that broker still can't place a client with a particular lender or get the outcome, what we do is we flick them across to broker number 2. And then often broker number 2 will have access to a lender, whether it's second tier lender, sometimes a third tier lender, to be able to find a solution there for that client.
Okay, well, we're just come up to the 1 hour mark. It's probably the right time to wrap things up. I'll urge everybody watching and listening to take advantage of the free strategy session offer that AllianceCorp is making today. The contact numbers on the screen, or you can go to the website. But it's a great opportunity to have your personal situation analysed without any cost, without any commitment, to have a chat with the team at AllianceCorp to see what the possibilities might be for you personally. Thanks for everybody for your participation today, for your comments and questions. We also conduct a poll towards the end of these webinars, asking whether they found the information informative. Pretty much everyone who's answered the poll today says yes, very informative. So thank you for that. And thank you, Jason, for a great presentation. Lots of wonderful information, good illustration with graphs and charts, and giving people an idea of how to move forward and actually create a portfolio, even people on average incomes.
Absolutely, Terry. Look, it's all about having confidence. So if you want confidence, sit down in one of these complimentary sessions. That's what we do. We educate you on the market, show you how you can do it, get into the market as quickly as can, and sort of fast track your results there in terms of building your portfolio. So thank you for having us, Terry.
You're welcome, Jason. Let's do it again soon. And my parting word to people is something I said a little bit earlier. I think it's really important. Build your team before you build your portfolio. Start the process of building your team by having a chat to Jason and his team, taking advantage of the free strategy session offer. Okay, we'll do it again soon. Bye for now.
Thank you.